In this week's video, we'll review the latest charts to help us answer the question, is the stock market out of the woods, or is the worst yet to come? Since many segments of this week's video refer to charts as of Thursday, January 17th, thought it was important to note before we begin that the gain on Friday, January 18th, really had no material change relative to the comments that follow, because there was no material change to the chart. Thursday, we closed above a downward sloping 50-day. Friday, we're still above a downward sloping 50-day. We still have a series of lower highs and lower lows. And anecdotally, you can make an argument that this is somewhat of a panic to get in slope, retraced, panic to get in slope, retraced, panic to get in slope, retraced. A very, very similar slope during Friday's session. And any comments that follow about the slopes of the moving averages, nothing changed. Very, very similar look relative to what was in place as of Thursday's close. Remember last week we said the January 10th chart was very, very similar to these four bullish cases. If we fast forward to the close on January 17th, 2019, we see the S&P 500 has closed above its 50-day moving average, not that discernibly different from this point here, this point here, this point here, or this point here. But as of January 17th, we can also say it's very, very similar to this point here, this point here, this point here, and this point here. It's a noisy chart here. We'll walk through it step by step. Remember, January 8th in short takes, it would not be surprising to see the S&P 500 rally back to the 2600 to 2670 area before retesting the December 2018 low sometime in the next 3 to 6 weeks, which would equate to late January of 2019 to mid-February of 2019. The retest of the low in the 1987 case came 5 to 6 weeks after the original plunge low. 1998, it came roughly 5 weeks after the original plunge low. 2011 case, 7 weeks. 2016 bullish case, about a month later. This is what our chart looks like in the present day, 3 weeks after the plunge low. I think it's pretty fair to say it really doesn't look anything like this. It really doesn't look anything like this right now. You could say it looks like that, possibly. That's to be determined. And it doesn't look very much like this. This is a big move here. Given that we're only 3 weeks off the low, it is still within the realm of possibility that we could see a retest. And under our approach, we're not waiting for a retest. We're data-based. So if a retest occurs, it occurs. If it doesn't occur, it really doesn't change our approach in any shape, form, or fashion. Remember, some of the things that we'll be looking for in terms of bullish outcomes. In every single one of these cases, eventually the S&P 500 cleared and held above the orange 200-day moving average. We should also note it is unlikely that this V move here continues indefinitely into the future. Typically, you see some type of consolidation after the plunge low, possibly even consolidation above the 200, and in this case, somewhat of a creeping consolidation look as we creep higher. 2011 case has consolidation and sideways movement below the moving averages and in the moving average cluster, something that's still possible in the present day in terms of in the moving average cluster or even below the moving average cluster. Consolidation below the moving averages here, break above, and then consolidate above all of the moving averages. This type of consolidation here, and this type of consolidation here, and this type of consolidation here after a bullish move typically is a good sign. So from a bullish perspective, if we plow through and consolidate on the other side, that would typically lend itself to favorable longer-term outcomes, which just speaks to probabilities. And remember, in 3 of the 4 cases here, the first attempt to clear the orange 200-day moving average was successful. So if we blow right through this on the first pass and hold above, that would be a good sign from a bullish perspective. All right, let's flip back to the bearish cases. Remember last week, January 10th, 11 trading days after the plunge low, fair to say that we look similar to the 4 cases on the screen. We really haven't seen enough yet to differentiate January 17th, 2019 in any specific or serious way from this case, or this case. Given the sideways movement here and the action near the 50-day, this would probably be the least similar chart of the 4. This is later in the 2008 bear market. This look is earlier in the 2008 bear market. There is one noticeable and potentially relevant difference between this chart and these charts, and it's the slope of the 200-day moving average in orange. This is a fairly indecisive, keep an open mind, flattish look to the 200-day moving average. Contrast that to this negative slope here, negative slope here, clearly negative here, much steeper here, and somewhat similar here. Thus, the 2015 case tells us, even if we break above all of the moving averages, it doesn't necessarily mean that we're out of the woods. But with this flat look here, we have to be open to all outcomes, including a V push and consolidation above the moving averages. That's all to be determined. The good news is, in the present day, since the moving averages are relatively close together and we still have somewhat of a tight cluster, the market would only have to move roughly 4% higher to get to this side. That's quite a bit different than the range and gaps between the moving averages here. Quite a bit different than what we have here and even here at this stage. Telling us that we probably don't have to wait too long to get better information one way or another. We could either be rejected somewhere in this area or plow through and start consolidating above. More constructive consolidation occurs above the moving averages. Most of this is above. All of this here is above the 200-day, and for the most part, above the moving average cluster. Contrast that with the 2015 case where we do get consolidation, but it's really not above the moving averages. For the most part, it's inside the moving average cluster, or at least about 50-50. Here, your consolidation occurs in the moving average cluster. You go sideways for a while. Here, it happens in the moving average cluster. So we should learn something either way. And we can also draw some very, very simple trend lines here that also fall in this 4% range. Again, telling us some good information could be coming either way relatively soon. And in last week's video, using a chart dated January 10th, we said it was a good sign for the most part that price blew right through the lower box. If we fast forward a week now using a chart on Thursday, January 17th, and we're using closing prices here, here's the chart a week ago. You could see we cleared this level here on a closing basis. And as of the close on Thursday, January 17th, we're right back to basically the area where the plunge began. This was support, this was support, this was support, then it broke. It's fairly logical for the market to try to rally back and fill that white space. So getting back to this point doesn't really tell us that much. However, the way that we've moved and some of the things that have happened in here tell us to keep an open mind about the market blowing through all of this in a bullish manner. Here's where the plunge starts, right in here. Support was near that level. The first time we came up to that level, it acted as resistance. Same thing in the 1998 case. We get this consolidation. The plunge occurs from here. We move our way back up to that box. What once was support may now act as resistance, and then the retest of the low came. So it's possible that we're seeing something like this, where we have somewhat of a V bottom. We get back up to the plunge area and move in this direction. We get somewhat of a V bottom. We move back up to the plunge area, and then it's possible that we'll move in this direction. This segment of the video here will probably be a little bit more insightful for clients relative to a question like this. Why are we holding cash, stocks, and bonds? As we noted last week, when we see the market going up in the short term, it's very, very easy to feel that we're missing out. Our goal is to put more capital in harm's way when the odds and hard data improve. Some visuals might be helpful here. This is a good time to be fully invested in here. There's a big, big move coming here. And this is what our generic and for illustrative purposes only moving averages in the market's profile looks like here. This is the type of profile, especially during the earlier stages of a trend, that typically offers a favorable risk-reward trade-off. This is the type of profile, especially early in a new trend, where we like to be fully invested in equities. How does this exact same chart look today? Does it look favorable like this? As of Thursday's close, the answer is it doesn't look anything like this. In fact, you can make an argument that this is almost the mirror image of this. Blue, the fastest moving averages on top with a positive slope. Blue, the fastest moving averages on the bottom with a negative slope. Slopes of all of the moving averages positive. Slopes of all of the moving averages negative to flattish. In 2019, it's not a question of if the market's going to go higher. It's a question of prudent allocation of our resources from a risk-reward perspective. Sometimes people win big buying lottery tickets. That doesn't mean it's a good probability bet. If really good things are going to happen for any length of time, such as a time frame that would align with an investor's outlook rather than a trader's outlook, it's basically virtually impossible for the data to not improve over time as it did here in 1988. In our approach, there's a transition phase where we incrementally add to the growth side as the odds and data improve. So when we get over here, hypothetically, we're fully invested. So a fair question is, this is our favorable profile. Does the present day look anything like this? No. Does the present day look anything like this? Not yet. And you may be watching this video and take that as a bearish forecast. Nothing could be further from the truth. We're simply making a factual statement about the market's current risk-reward profile. It very well may improve as it did here, and if that's the case, we'll be more than happy to continue to scale in on the equity side. If you had some cash near the lows 2011, had you really missed out? If you executed well and incrementally added to the growth side as the data improved, if you look back from point B after big gains, you probably didn't feel like you had missed anything back here. Once again, let's use some visuals. 2013. This is an excellent risk-reward type market here with wonderful gains that follow for a long period of time. This is what the market's risk-reward profile looks like right here. This is favorable from a probability perspective. This is the type of look here where we want to be fully invested in equities. Does the present day look anything like any of this? Not even close. In fact, instead of the 50-day moving average working its way back to the top, as it did here in January of 2013, it's recently worked its way in an efficient manner to the bottom. We believe that there's reasons to be bullish and optimistic in January of 2019. And even if good things happen, nothing says we couldn't get a move like this all the way back above the 200-day moving average and then get some form of a pullback. And this is a fairly significant pullback. So a move like this and this and this and this is well within reason from a historical perspective. And what this does for us, this time here and this time here, gives the data time to catch up. And that's typically how a sustainable low is made. Remember last week we said it's very, very easy to front run the data here, throw all caution to the wind. This is a very, very strong and convincing I'm missing out move here off of this low. We come down, we make a V bottom. If we threw all caution to the wind in here, it wouldn't have worked very well. The loss from this point here to this point here, 34.47%, meaning 100% of this move was retraced and then some. So this chart here, this is our generic and for illustrative purposes only moving averages on October 26th, 2001, which would be somewhere right in here, which is very, very similar to the present day because we just closed above the 50-day moving average. In fact, the present day chart looks very similar to the chart on October 26, 2001. Meaning, if we had allocated properly and moved at a measured pace, when you're here, you're not all in. And it's much, much easier from a risk-reward perspective to deal with the reversal here, both from a tactical perspective and a psychological and emotional perspective. It's extremely important to make these points unequivocally clear. Covering this case is not a prediction of what we believe will happen in 2019. That is to be determined. We are not taking a bearish stance. We are not bearish. We are simply acknowledging the uncertainty related to the market's current profile. This is a set of facts. We could see it, measure it, and put it in a model right here. Can't debate the look of this chart here or the slope of these lines. And this is as of January 17th, 2019. It's not about whether or not the market moves higher in 2019. It's about prudently allocating our capital based on the facts that we have in hand today. Is this the only case where something like this happened? No, last week we covered the rally off of the 2008 low here. Remember in last week's video? Here's the same moving averages here in February of 2008 in here. Here are the exact same moving averages a week ago on January 10th, 2019. And nothing materially has changed on this chart. You can just take price and move it here. And as we covered last week, the S&P 500 retaking a downward sloping 50-day moving average occurs in every single one of these bearish cases, including the one that we're covering now in early 2008. Hard to make an argument that this move here is appreciably different from this move here. Slopes of your moving averages are all down, blue is on the bottom. Slopes of the moving averages, for the most part, are all down, blue is on the bottom. We've already noted the exception about the 200-day, telling us to keep an open mind about bullish outcomes. In the 2001 case, we could negate a lot of this relatively soon. Notice here, we never make a confident move above the flattish 200-day moving average in here. Well, that could change very, very soon. If we make a confident move above 2750 and hold there, we start to look different relative to this case here. First move up to the 200-day rejected. Second time, a very short stay above the flattish 200-day and then firmly rejected. Same thing here. The only difference is the 200-day moving average is in red. So we'll learn something relatively soon. If we make a push to the 200 and it looks like this, not good. If we make a push to the 200 and it looks like this, and then we consolidate above, much, much better. The whole point of putting together the bullish and bearish roadmaps was to help us to try to discern between the bullish and bearish cases as time goes on. Even here, there's no firm and convincing push above the 200-day moving average here. We go up, we make a high. This is a lower high, and we somewhat hug the downward sloping 200-day. That's quite a bit different than this case here, where we push higher. Quite a bit different than this case here, where we clearly blow through it and there's white space. And this is still more constructive here. We hold above, there's some white space. Here we blow right through it like a hot knife through butter, all kinds of white space. If we stick to our discipline and stay aligned with the data, we can handle a case like this, where a 52% loss occurred after the failure at the 200-day. Think about your risk reward there. We just said we're about 4% below clearing all of the moving averages in the present day. So if we jump the gun for a potential 4% gain in the present day, history tells us it's within the realm of possibility that a 52% loss could follow that, or even something on the order of a 30 to 35% loss could follow that. A 4% gain relative to a 35 or 50% loss does not equate to a favorable risk-reward ratio. The risk-reward profile could improve substantially relatively soon. We just need to take it day by day and take our patient, prudent, measured, and data-dependent approach. Again, want to make it abundantly clear. Showing these cases is by no means a prediction or a stance about what's going to happen going forward. You may watch these videos and just filter out all of the bullish cases that we're covering. Maximum flexibility is needed because today looks very, very similar to negative cases. In 2019 looks very, very similar to several cases where really good things happened following discernible improvement in the market's risk-reward profile. If we look at the 1998 case up close, this is somewhat of a V-bottom look here. If we were in the markets the third week of September here, we don't know this is going to happen. It's still within the realm of possibility that the market will have some type of pullback. It's also within the realm of possibility that it's going to blow right through all of the moving averages. We're in a good position to deal with both outcomes. You can visualize the concept of the data improving here, allowing us to scale back in. The market's profile looks a lot better right here than it does down here when it first crossed the 50-day. And some really, really good things happen from here to here. We're obviously watching things closely, and as of the close on Thursday, January 17th, we were allocated in line with the evidence. Kathy updated the trend strength model during Thursday's session, intraday near the session high, and the trend strength model did move a little bit. It went from 0 to 1, and it may still be at 0 at the close on Thursday because we closed off the high. To refresh your memory, the trend strength model goes from 0 to 100. And in theory, it's telling you that 1% of the questions that we're asking about the market's profile are coming back bullish, and 99% of them are coming back and saying it's still prudent to take a patient, measured, and data-dependent approach. When we see green screens, when we have cash, it's very, very easy to get into the short-term mode, let our emotions come into the equation, staring at the screen, watching things tick by tick, forgetting the bigger picture, the facts that we have in hand, and feel like we're missing out. And from this missing out point B here, really, really bad things happened. It's too early to say whether this is the start of a new bullish trend or a 100% normal and to be expected counter trend move within the context of an already established, existing, and ongoing downtrend. This is a high. This is a lower high. This is a lower high. This is a low. This is a lower low. This is a lower low. And this is a lower low. And the slopes of our moving averages have not really changed materially yet. We're missing out, 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 we're missing out. And in every single case, 100% of those moves was fully retraced and then some. Moral of the story, really good things could happen over the next 2 years. A crushing decline could still be just weeks away. And the facts that we have in hand call for maximum flexibility. Tell us to take it day by day, no front running the data, and no forecasting. Have to remain open to eye-popping gains and crushing declines. As we noted on Twitter this week, we are walking through every single day in the stock market between 1950 and 2019. And in essence, we are updating the CCM Bird Strike Crisis Manual. Here's an example of one of the annotated charts from that manual that we're putting together. And it gives us a real-world historical perspective about ignoring risk and just hoping that things will get better. This is 3 trading days before Black Monday, Wednesday, October 14th, 1987. A lot of red and yellow flags here. It's somewhat of a vertical move here, a breakout, it fails, and then we get a sharp, sharp sell-off, another breakout, another failure, and price doing some things that it hasn't done anywhere in the rearview mirror. This is 2 trading days before Black Monday. Steep decline, steep decline, steep decline. This is 1 trading day before Black Monday. Another gigantic, steep, harsh, and rare sell-off. So let's assume in December, while similar things and extremely rare things were happening, that we just looked the other way and hoped that things would get better. It's hard to make an argument that this type of move from here to here and this type of sell-off is really discernibly different from the sell-off that occurred in Q4 of 2018. So in this case, if you hoped everything would be okay on October 16th, 1987, how did that work out? We're literally going to step forward 1 day on this chart. This is the type of risk that we were facing in December. an extremely uncertain situation. These are high-low close bars. The market gapped down the next trading session over 20%, rallied intraday, and then came back and closed at the exact same spot that it opened. And as we've covered in the past, if you fool around with risk management in a period like this, hypothetically, we could have had $1 million balance here on Friday, October 16th, 1987. If we just ignored all of this, at the open on Monday, our $1 million balance would have been worth $795,323.50. Literally, in a matter of milliseconds, we would have lost over $200,000. And as we've covered in the past, we do not regret managing risk in that situation, but there are things that we can do to manage risk in a more efficient and proactive manner. And the whole concept of putting together the CCM Bird Strike Crisis Manual is basically the same reason why there are manuals for pilots and commercial airliners. The Bird Strike Crisis Manual is being meticulously created in Microsoft PowerPoint. Why? I'm going to have an electronic frame on my desk that constantly scrolls through all of these charts that we've created. They cover every possible conceivable situation in the markets, from unexpected plunges to unexpected rallies off a low and everything in between. We've already made a lot of progress on this project and learned a great deal that is going to help us tremendously going forward. If you look in the left margin of your screen, here are all the charts that we've annotated and cases that we've annotated between 1950 and 1987 so far. Thus far, we've annotated 102 charts. We're going to work our way all the way up to the present day, and then we'll go back to the first trading day that we have at stockcharts.com for the S&P 500 and work our way back up to 1950. This project will be used to double check and tweak these procedures that we've covered in previous videos, and it will greatly reduce the probability of having a bird strike take out an engine at 30,000 feet and put us in a situation that we're not prepared for. The purpose is to turn over every single stone from every conceivable angle to make sure a drawdown like the one that we just experienced never, ever happens again. In the markets, we can't guarantee anything, but we can guarantee that we've done everything possible to reduce the probability of something similar happening in the future. We'll be covering the Bird Strike Crisis Manual in more detail in the weeks and months ahead. This project is going to take a long time and is absolutely positively going to be worth it. A few weeks ago, I said these changes here probably wouldn't have the same noticeable impact on performance relative to the screens that we added in May of 2017. Having made the first pass at every single trading day between 1950 and 1987 thus far, I take that back. I believe that this project will be incredibly important and incredibly helpful for us for many, many years to come. We talked in November and December a lot about press conference risk. And unfortunately, prior to Christmas, at least from the market's perspective, nothing was really resolved in a favorable manner, which led to an extremely rare and violent sell-off in the stock market. And we talked about press conference risk, and we knew that most likely these boxes would begin to shift. And sure enough, after Christmas, for the most part, the market's perception of these items has started to shift in a significant and favorable manner. And part of the V-bottom is related to the press conference risk that we talked about for several weeks. It's also extremely frustrating that we were well aware that a massive bounce could come, as evidenced by this tweet on December 20th. History tells us stock market corrections, and especially bear markets, can experience sharp, oversold counter-trend rallies. And the whole reason why we stepped out in an incremental fashion was that we respected that some type of massive rally could come at any time. As of the close on Christmas Eve, we really didn't have anything to hang our hat on, and as the 1987 case shows, or the dot-com bust or the financial crisis, looking the other way and hoping that things will get better can have devastating consequences. As we've mentioned in past videos, our concepts and knowledge of the market were sound during that entire process. We've just got to make some changes to the bird strike playbook, which is why we'll continue to take a meticulous look at every single trading day in the S&P 500's history. We covered this from Ned Davis Research a few weeks back. 2018, very similar to these three periods here. In this case, we got a very, very sharp rally that was completely retraced, and the low, a lower low, didn't come for 5.5 months. Similar case was 2002. Big move, fully retraced. A lower low came 2.5 months later. And in the 1962 case, a lower low came a month later. It's really too early in the present rally to determine whether we're really going to get a V-bottom or it just feels like a V-bottom. If we do get a V-bottom, let's say hypothetically the market just keeps rising day after day after day after day and goes on to make new highs and rallies for several years, then we would also have to consider adding some procedures to the bird strike crisis manual or playbook. That's to be determined, and we'll only know that in a few weeks or months. We've seen the signs of a bottoming process. We covered it in the January 5th video. We just have not seen a discernible improvement in the hard data. And that includes fast forwarding a week to Friday, January 18th. We updated the model intraday. This number is still stuck between 1 and 2. Typically, when we see what we've seen since the lows in December, bottoms are typically a process. 1987 case, 45 days after the original low. The retest came in this case 37 days after the original low, and in this case 56 days. So far, we have a V. And as you might imagine after watching these videos week after week, we do our homework here, and we are well aware of all the other stats that are floating around right now. A lot of talk about breadth thrusts and things like that. Well aware of all that, and it is positive. However, it doesn't negate the look of this chart here. It is what it is. There's a reason why the moving averages look as they do in the present day. There's a reason why the market's making a series of lower highs and lower lows. And there's also a reason why we're always covering the bullish cases in these videos. We are well aware that the market could blow through all of this, consolidate on the other side, and resume the primary bullish trend that was in place prior to the October peak. But under our approach, we're not going to guess here. If really good things are going to happen for a long period of time, this chart will not look like this. And firsthand experience and knowledge of market history tells us when we have charts that look like this or this, we shouldn't take for granted that the market's going to blow through anything and start making a series of higher highs. It felt really good and bullish in here in 2001, and it felt really, really bad over here. It felt really good and bullish, and everyone said the worst is behind us here in 2008. And with chart profiles like this, it didn't feel really good on the right side of this chart when the market lost an additional 52%. And it's also very, very possible that the present day chart is going to start to morph into something that looks like this eventually, or like this eventually. And if that's the case, the data in the model will start to improve at a more rapid rate, and we are more than happy to start to scale in, adding to our equity exposure when the market's risk-reward profile improves. A number like this off the low in 1987 reminds us that the fear of missing out can be overstated, and the fear of missing out can lead to really, really unfavorable outcomes. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.